Two investors put in the same amount, in the same market, in the same month. One panics and sells during the next downturn. The other doesn't. Same market. Completely different outcome. The difference usually isn't luck. It's how their portfolio was built to behave before the crash ever happened. Most people evaluate a portfolio by asking one question: what's the return? So they compare 12% versus 15% and pick the bigger number. But that question only tells you what happens when things go well. It tells you nothing about what happens when markets fall. And markets will fall more than once over any long investing life. A portfolio that looks great on a good year slide can behave very differently when you actually need it to hold up. To really compare two portfolio designs, you have to look at all three kinds of markets they live through, not just the best one. Let's take two portfolio designs and run them through three market conditions: a rising market, a flat or sideways market, and a falling market. This isn't about picking winners. It's about understanding why the same design can behave so differently depending on the environment. Design 1: Equity only. This is a portfolio built entirely from equity mutual funds, no other asset class involved. Its whole engine is market growth. When the market goes up, this design captures it in full, sometimes with some added outperformance if the funds are well selected. There's no ceiling on the upside. Design 2: Equity plus a second differently behaved building block. This is the Plan A plus Plan B idea. Most of the money still sits in equity, but a portion goes into a structured product, a market-linked instrument designed to keep performing within limits even when the equity market itself is flat or falling, in exchange for giving up some of the upside if markets run hot. For a full breakdown of what a structured product actually is, that's covered in a separate video. This one's just about how the combination behaves. Now, the rising market scenario. If equity markets are having a strong, sustained run, Design 1 benefits fully. It has no cap. Design 2 also benefits, but the structured product portion has a capped return, so the overall portfolio's illustrative rise is slightly lower than pure equity. This is the one scenario where equity only genuinely wins outright. That's an honest trade-off, not a flaw to hide. The range-bound scenario. This is where things get interesting. When equity markets go sideways for an extended stretch, delivering low single-digit returns, or basically nothing, Design 1 goes sideways too, because it has nothing else pulling its weight. Design 2, however, still has its structured product component working toward its target return. Because that component isn't purely dependent on the market going up, it's built around a specific market condition being met, not a rally. So in a flat market, illustratively, Design 2 can still post a meaningfully higher combined return than Design 1, purely because one part of it isn't waiting on the market to move. The falling market scenario. This is the scenario people underestimate the most. If equity markets fall, Design 1 falls with them, direct exposure, no cushion. Design 2 also feels the equity portion falling, but the structured product portion is built with a defined downside threshold. It's designed to protect capital down to a certain level, even though it isn't risk-free below that level. So instead of the whole portfolio moving in lockstep with a falling market, Design 2's fall is illustratively shallower, sometimes closer to flat than negative, depending on how deep the fall is and how the structured product was constructed. Why this matters more than the return number itself. The real cost of a crash isn't just the paper loss, it's what the investor does next. An investor watching a portfolio fall in a straight line with the market is far more likely to panic sell near the bottom, locking in the loss permanently. An investor whose portfolio is falling less sharply, even if it's still down, tends to have more patience to stay invested through the recovery. The design isn't just about the number on the screen. It's about whether the investor stays in the game long enough for markets to do what markets eventually do, which is recover. Say a market falls 20% in a year. A pure equity portfolio illustratively falls roughly in line with that. A combined portfolio with a portion in a downside cushion structured product might illustratively be down only 6 to 8% in the same period, Not because the equity holdings performed differently, but because a chunk of the portfolio was built specifically to behave differently in that scenario. These are illustrative, backtested style figures for explanation only, not a projection or guarantee. Past performance never assures future results, and structured products below their protection threshold can still lose capital. Before you judge any portfolio by its best year return, ask what it's designed to do in the other two market conditions, flat and falling. A design that only shines in a rising market isn't necessarily a bad design, but it's an incomplete one if the goal is to actually stay invested for the long run. That's the real comparison, not which portfolio wins in the good year, but which one you can actually live with in the bad one. Thanks for watching. Check out the video description. We've packed it with resources just for you. If you found this video helpful, please give it a thumbs up and share it with someone who needs it.